The ECB cuts rates by 25 basis points as inflation falls below target. US rate cut bets are pulled back following stronger retail sales. Australian jobs growth surges, and China announces further measures to support its property market. That's coming up in our 5 Things in 5 Minutes. And then in our bonus deep dive interview, ANZ Economist Maddy Dunk looks at the effect that changing household sizes and investor lending are having on Australia's housing market.
We're now seeing more share houses compared to around 2018-19 levels. We're also seeing that more older children are moving back in with mum and dad due to affordability constraints.
But first in 5 and 5 with ANZ. The European Central Bank cut its key deposit rate by another 25 basis points to 3.25% overnight, aided by inflation falling to 1.7% year-on-year in September, and that's below target. ANZ head of G3 Economics, Brian Martin, says lower interest rates will help reduce Europe's high savings rates and support growth.
We're looking for rates to fall to 2% by the summer of next year. So I think there is going to be a case at some point in the future, which is in our forecast, that the ECB is probably going to have to continuously cut rates at consecutive meetings. Now, inflation will pick up a bit in the fourth quarter of this year. The ECB has not committed to a December rate cut. I think it wants to see incoming data before considering another move then, but I certainly think as far as the landscape is concerned in 2025, the arguments for consecutive rate cuts will definitely be in place.
Number 2, US retail sales beat estimates in September, rising 0.4%. US Treasury yields rose 4 to 8 basis points as traders saw the strength as meaning the US Fed will keep rates higher for longer. Markets are now pricing in just below 50 basis points worth of cuts across November and December. Brian says the numbers suggest domestic demand remains strong across Q3.
That, to me, suggests that recession risks remain muted, that the prospect of the economy sliding into recession in coming months really remains rather low, especially as the labour market is still firm. On that basis, I think the data are signalling that the Fed will proceed cautiously with rate cuts in the future.
Those rising Treasury yields saw the US dollar index up 0.2% at 4 a.m. Sydney-Melbourne time. The Aussie dollar was also stronger, up 0.5% at 67.00 US cents. The Kiwi was up 0.1% at 60.61 US cents. Number 3. Australia's unemployment rate was flat at a revised 4.1% in September. That came as employment surged by 64,000 and the participation rate rose to a new record high. ANZ economist Maddy Dunk says employment growth has averaged 45,000 over the past 6 months.
We're seeing this real resilience in the labour market and particularly seeing a really strong participation response. If you look at participation, it's at a record high at the moment. We've got more people active in the labour market, more women in particular active in the labour market. So that's suggesting that the supply side of the labour market is continuing to adjust and that balance between labour supply and demand has actually shifted.
Number 4, Maddy says the numbers are testament to resilience in the Australian economy.
For the RBA, the fact that we are seeing, 1, the strength in employment growth, but 2, that participation response, it just tells us that rate cuts aren't going to happen anytime soon. And if you look at the different indicators of labour market tightness that the RBA looks at, it does suggest that the labour market is still reasonably tight. And in an environment like that, the RBA should be in no rush to start easing rates.
Number 5. Chinese investors were disappointed yesterday by policy announcements from China's housing ministry to spur completion of unfinished projects and renovate homes in rundown areas. ANZ Chief Economist for Greater China, Raymond Yung, says the announcement was less economic stimulus as expected by the market and more about preventing a further property slump.
To us, this is a major measure to minimize the liquidity risk and the financial constraint facing the developers as well as the related supply chains. So I think that the package and the briefing today seems to be a positive in terms of risk management that prevent China from falling into a subprime property risk. But this is not a policy package to support a V-shaped rebound of China property market.
Raymond Jung there. Now in our bonus deep dive interview, ANZ Economist Maddy Dunk spoke to Bernard Hickey about how changing household sizes and a rise in investor lending have been affecting Australia's housing market recently.
Household size has really been on a bit of a roller coaster recently. We saw that household size fell sharply during the pandemic when people wanted space, and a lot of that was due to share houses breaking down. So you can think of it like the death of the share house. But we know that housing is becoming less affordable. We also know the economy is slowing, and that has started to put a bit of pressure on household size. So we've started to see household size creeping up a bit. And when we think about household size relative to 2018-19, it's fallen by about 0.04 persons. So that might not seem like much, but if you saw household size fall back to those 2018-19 levels, that would reduce dwelling demand by around 160,000 dwellings. So it has quite a big impact on the demand story. And one of the things that we know is that household size tends to track the unemployment rate. So we expect that the unemployment rate will continue slowly drifting upwards. That should mean that you see household size also drifting upwards, and that will reduce demand for dwellings. And it is one of the reasons that within our forecast, we do have a bit of slowing in growth next year.
And how are the household sizes getting bigger? Is it more people sharing houses, or is it things like people moving back in with parents? Or do we have a sense of what type of, what that means when household sizes rise?
So it's a bit of both. I said before that during COVID, we had the death of the share house. Well, share houses are starting to reform, and a lot of that is due to cost of living pressures. So we're now seeing more share houses compared to around 2018-19 levels. We're also seeing that more older children are moving back in with mum and dad due to affordability constraints. So there are a few factors going on that are pushing up household size. And so far, we've only seen a very small move upwards from the pandemic lows, but I expect that will continue to increase over time.
And one of the themes is a growth in investor lending. What's the story there?
We've seen really strong investor lending, particularly in markets like WA. If you think about the share of investor lending relative to a few years ago, investor lending's actually doubled as a share of total lending in the WA market. And I think that's one of the really interesting stories over the last year or so is the fact that if we think about total lending, it's been really resilient, but a lot of that's coming through from investor lending. We know the rental market's still very tight. There's been a lot of talk about migration, net overseas migration. And one of the things to keep in mind is that when new migrants come to Australia, they actually tend to rent rather than buy their own homes. So if we look at the data, it's more than 80% of new migrants who tend to rent. So that's putting pressure on the rental market, which we already know is very tight. Rental vacancy rates are hovering around record lows. They've started to inch up a bit, but not that much. And if you think about the growth in advertised rents over the last few years, while we are likely to have seen the peak in advertised rent growth, there's been this huge level shift. So advertised rents are up almost 65% in Perth over the last few years. If you think about nationally, they're up almost 40% since the end of 2019. So a big shift there.
Maddy Dunk there. I'm Alex Tarrant, standing in for Bernard Hickey, who is away this week on family leave. That was 5 and 5 with ANZ for Friday, October the 18th. Catch you next week with more on China's moves to support its property market.
This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.